entrepreneurs and business owners often need funding for a wide range of needs: expanding operations, purchasing inventory, hiring more staff, or upgrading equipment. Loans can provide the liquidity to help overcome seasonal fluctuations in cash flow or to make strategic investments that can propel your business to the next level. In this video, we're sharing how to get small business loans for your business. SBA loans are partially guaranteed by the Small Business Administration, which makes them less risky for lenders and more accessible for small businesses. The most popular types include the SBA 7A and 504 programs. Key features of SBA loans will be: SBA loans have fewer interest rates. Reduced risk allows lenders to offer competitive interest rates. It has flexible terms. Repayment periods can be extended up to 25 years for real estate. It has broader eligibility. Loans can often be accessed even by businesses with limited credit history. Application processes need to follow SBA guidelines. Review the SBA's requirements for each loan program. Lender search. Find a lender participating in the SBA program. For documentation, you need to submit tax returns, a business plan, and other financial papers asked by a manager. SBA loans are ideal for businesses that meet the criteria but require a longer processing time. Now, let's discuss important steps to secure a bank loan. First, prepare documentation. Gather detailed financial statements, tax returns, and a clear business plan to prove the loan will be used effectively and repaid on time. Second, meet credit requirements. Most banks require a good credit score and evidence of stable business history. And third, offer collateral. Securing the loan with assets may improve the terms. Secure bank loans are a great fit for businesses that are financially stable, as they often offer the lowest interest rates. Finding the right lender is crucial to securing favorable terms. We are sharing popular lenders that can help you find the funding solution best suited to your business needs. Number 1. Bank of America, a traditional bank that offers a range of lending solutions, including lines of credit, term loans, and SBA-backed loans. Their personalized service is especially beneficial for businesses that already hold accounts with them. Number 2. Wells Fargo. Known for its comprehensive lending solutions, Wells Fargo provides flexible terms and competitive rates, particularly for SBA loans. It has a broad network and strong resources for supporting small businesses. Number 3. Lendio, an online lending marketplace that matches businesses with loan products tailored to their unique requirements. Their broad network of lenders helps find financing options with varying interest rates and terms. Number 4. Fundbox. Known for invoicing, financing, and lines of credit, Fundbox provides businesses with cash flow solutions and a streamlined application process that works well for small businesses with unpaid invoices. Now, let's discuss different types of small business loans that you can get for your business. Number 1. Term loans. Term loans provide a lump sum upfront that is repaid with interest over a set period. These loans are best for businesses looking to fund specific large-scale projects like expansions or acquisitions. Benefits of term loans will be fixed payments. It has predictable monthly payments, providing clarity for budgeting. And second benefit is flexible terms. It has customizable terms ranging from less than a year to long-term up to 10 years. To apply for a term loan, you're required to ensure a strong personal and business credit score of above 680. Then you need proper cash flow. Lenders need to see consistent revenue and profitability. Last, if applicable, then you're required collateral. Secured loans often require business assets. Term loans are versatile, but it's crucial to understand their fixed repayment obligations. Number 2. Lines of credit. A line of credit provides flexible access to funds up to a certain limit. Once approved, businesses can draw from this revolving credit as needed to cover working capital or unexpected expenses. Advantages of lines of credit. Interest on drawn amounts. Pay interest only on the amount borrowed. Revolving nature. Repay and borrow again within the credit limit. Flexible usage. Suitable for managing cash flow or urgent investments. To qualify for a line of credit, you need credit worthiness. Higher credit scores above 680 and consistent revenue improve approval chances. And collateral. Secured lines may offer higher limits with assets as collateral. Lines of credit are ideal for businesses needing ongoing access to capital. Number 3. Invoice financing. Invoice financing allows businesses to borrow against their unpaid invoices to maintain cash flow. This solution is particularly helpful for businesses with long customer payment cycles. Key benefits will be fast funding, access cash quickly based on outstanding invoices. Second benefit is flexible. Use funds for any business need. And third benefit is customer. Credit-based. Approval depends on the creditworthiness of the invoice customer. To get invoice financing, you need to follow two major requirements. First, you need to track invoices. Maintain an organized system to monitor unpaid invoices. Second, understand costs. Be aware of fees associated with borrowing against invoices. Invoice financing can stabilize cash flow and bridge the gap between billing and payment. Number 4, invoice cash advance. Invoice cash advance is a financing arrangement where businesses sell their unpaid invoices at a discount in exchange for immediate cash. Advantages are you get fast cash, quickly converts receivables into working capital. Second, outsource collections. The financing company handles collections directly from customers. And third advantage is non-recourse option. In some cases, the lender assumes the risk of customer non-payment. In this type of loan, points to consider is cost, higher fees compared to other financing options, and customer relations, ensuring clients are comfortable with third-party collections. Invoice cash advances can be a great solution for businesses with cash flow gaps and strong customer bases. Number 5, equipment financing. Equipment financing allows businesses to acquire machinery, vehicles, or other necessary tools without paying upfront. The purchased equipment itself often serves as collateral. Benefits will be your ownership. Retain ownership once the loan is repaid. Tax deductions. Potential tax savings via Section 179. Fixed payments. Fixed interest rates simplify budgeting. For application for equipment financing loan, provide detailed quotes for the equipment. Financial documentation. Submit financials proving repayment ability. Down payment. Be prepared for a possible down payment. Equipment financing is ideal for maintaining productivity with the latest technology. Let us discuss about secured loans versus unsecured loans. Secured loans require collateral, while unsecured loans rely solely on creditworthiness. Understanding the differences helps in choosing the best option. In secured loans, you will get lower interest rates. Lenders offer better rates due to reduced risk. Secured loans has higher limits, more accessible for higher loan amounts. In secured loan, you are at collateral risk. Assets may be seized in case of default. In unsecured loans, there are no collateral required, suitable for businesses without significant assets. Unsecured loans has higher rates. Higher risk for lenders leads to higher interest rates. Your approval is dependent on your credit score. Approval relies heavily on personal and business credit scores. Choose based on your business's credit and funding needs. Now, let's discuss the documentation needed to apply for a business loan. Personal ID, driver's license, passport, etc. Financial statements, profit and loss statements, balance sheets, cash flow reports, tax returns, personal and business tax returns for the last 2 years, business plan, a clear outline of loan usage and profitability, legal documents, articles of incorporation, licenses, etc. Organizing these documents helps speed up the approval process. Now, the most important task requirement for a small business loan. Lenders often look for specific criteria before approving a small business loan. Common requirements include credit score. A good credit score is vital. Revenue consistency. Regular income proves the ability to repay. Time in business, preferably at least 2 years of operations. And debt-to-income ratio ensures businesses can handle additional debt. Collateral. For secured loans, collateral may be required. Meeting these requirements increases approval chances. Make sure that you will compare business loans with lenders to lender. Comparing loans ensures that you find one best aligned with your business needs. During comparison, you need to focus on 5 key factors. Number 1, interest rates. Review both fixed and variable rates. Number 2, loan terms. Assess repayment periods and monthly payments. Number 3, approval time. Determine how quickly the funds will be available. Number 4, flexibility. Check prepayment penalties and usage restrictions. And number 5, lender reputation. Look for lender reviews and ratings. Thorough research ensures you select a loan that aligns with your business goals. And thank you for joining us today. This is fucking dumb, man. You fucking write like a fucking cunt. And number 5, lender reputation. Look for lender reviews and ratings. Thorough research ensures you select a loan that aligns with your business goals.